Good afternoon, all. I'm honored and delighted to be moderating this next panel session in which we'll be discussing the incorporation of ESG and climate considerations throughout the investment lifecycle. My name is Louisa O'Gorman. I lead ESG for Aon's M&A and Transaction Solutions team. And I'm joined today by a truly fantastic panel, Adina Shackleton, Neil Kravitz, and Ashim Pawn, and who have been at the forefront, and if I may say, championing the integration of ESG practices within their respective businesses. So before we start, I'd like to invite each of the panelists to briefly introduce themselves. So Adina, perhaps if we could start with yourself.
Great, thanks. So I'm Adina Shackleton, head of ESG at Permira. I've been with the firm for about 8 years, and we have a team of 6 working with investment teams on ESG pre-investment and post-investment on value creation.
Hi, Neil Kravitz from Arcus Infrastructure Partners. Arcus is an investor in the mid-market European infrastructure space, which for us is equity tickets between 100 and 250 million euros. We apply our approach across the full life cycle in the 4 sectors that we focus on, which is digital, transport, energy, and logistics and industrials. I have been involved in managing ESG at Arcus since 2016, and like Adina, we have a dedicated team within our business to help our investment teams, but also the portfolio companies to implement our ESG approach.
Ashim Pawn from Triton Partners. We're a European mid-market private equity buyout firm predominantly. I've been with Triton about 2 years. I have about 18 years in within sustainability within financial markets via an investment bank, a hedge fund, a long-only thematic investor, and then in my 20s I worked in politics for a little while for an MP and with an NGO, mostly around environmental risks and catalysts.
Fantastic, thanks all. So to set the scene before we kick off, I think it's fair to say that the integration of ESG or sustainability practices has evolved over the last couple of decades from what used to be perhaps more of an afterthought to now being an important and in some cases critical business consideration. That's in part due to national commitments, particularly on the environmental side, with the private sector being seen as pivotal in us reaching net zero targets. That's in part due to the ever-evolving regulatory landscape demanding much greater disclosure and transparency of sustainability practices. And as Gary Wilson, BVCA chair, earlier pointed out, in part due to investor demand and LP pressure on GPs, there's much greater scrutiny of ESG practices overall than even just a few years ago. And given this increased scrutiny, Adina, perhaps if I may come to you first, how has your approach to ESG due diligence specifically changed over the last couple of years?
Yeah, it's a great question. And I mean, we've been integrating ESG in our investment process since around 2010. But really over the last couple of years, it has evolved. We spend a lot of time working with our investment teams, so really helping them understand the ESG risks or opportunities to look at in investments so that they're kind of empowered to do this in the deal process. Also, in terms of topics, we've seen an evolution in the breadth of topics that we're looking at. So areas like climate definitely kind of being more of a focus during the due diligence process, looking at things like whether companies have a science-based target, what their kind of plans are around achieving that. We've committed to set a science-based target and we're going through the validation process, so I think that's going to become an increasingly important part of the due diligence. Also areas like human rights or compliance around new regulations like the CSRD, we're kind of looking at that much more during the due diligence process as well. And then beyond that, really kind of looking at value creation. So we have targets for our most recent buyout fund on areas like governance of ESG, climate, and board gender diversity. So we're really looking to understand how ready is this company to align around these targets post-investment and developing an action plan for that company actually as part of the due diligence process rather than coming to that during the investment period. And I just think overall there's much more of a recognition that the due diligence process can actually be used as a springboard for value creation post-investment and really help companies accelerate once we're invested.
Mm-hmm. Thank you, Adina. And perhaps, Ashim, if I may come to you next to add to that potentially and to see if on the flip side, there have been any occasions where you've perhaps walked away from a deal on ESG grounds.
Yeah, sure. And there are quite recent examples, in fact. I guess, structurally, we have systems for understanding core sustainability trends and underlying themes, and then interrogating them through lenses of things like regulation and relative economics of competing technologies and consumer preferences and geopolitics and such like. And quite a lot of energy tech investment opportunities have been sent our way, and we have to have a very kind of we have to have shades of understanding how fossil fuels may be used in the future. But actually, the example I was thinking of was in a theme which is much more emergent in terms of the focus within ESG, which is around biodiversity. And so about a year ago or something, a bank called up and they said, here's a company which is involved in producing protein in different ways from fisheries, so marine-based, seafood-based protein. Now, on the one hand, there's some thematic drivers. There's more people in the world trying to eat differently. Maybe this done properly could be a sustainable way of producing more protein for the world. But actually, when we dug into what this company was offering, it was things like bottom trawling using heavy weights, which rake up the seabed and give you kind of a one hit on the animal life that's there, and then leave you with a marine desert. They're involved in mangrove clearance for shrimp farming in parts of Central America, and then also in octopus farming. Now, all of these can produce protein, and the numbers look good, so the deal team were excited. But we thought, first and foremost, that there were real kind of civic society and consumer preference pressures either in place already or to come. And we thought for Triton, even leaving aside any potential future regulatory risks here, do we want to be associated with such activities? Could they negatively impact, even if this investment works out okay, would that affect our ability to raise future capital, to attract future companies as partners, and maybe even to attract talent as well? So we declined.
What a fascinating example, and particularly you mentioning biodiversity, which I often hear now described as the next frontier to understand and really get our arms around. Neil, any examples to add from your perspective?
Yeah, I think it's just much more front and center in all parts of the origination process. Over the last 3 years, in each of those years, we have filtered out between 9 and 12% of initial opportunities specifically on ESG grounds. Some of those, I would say, are big thematic elements like exposure to fossil fuels. Some, I would say, are traditional elements which private equity is quite used to on things like reputational risk, where we've looked into either a business's interaction with its stakeholders or a founder who maybe has a colorful history. And equally in the diligence process, our team, our IC, our advisors are much more acutely looking into the specific issues. And clearly there are some companies that are quite easy from an ESG perspective to deal with, but we are turning down opportunities when they're in close to final stages within our investment committee because of it. But more likely, and I would say more practically, there is building in of assumptions that maybe in the past people might have looked at as a downside case related to ESG. Those are now being built in as base cases. And to give you an example, we recently bought a business where it has a fleet of assets which has a reasonable emissions profile. And in our base case, in terms of investing to upgrade and change that fleet to much less impacting a much better ESG profile, we went to what I would consider previously would have been considered a worst case scenario and included that as our base case. And that, I think, is really just featuring in a much more heightened awareness that this is something that really we'll all have to deal with and have to really have as part of our investment cases.
Then perhaps continuing in terms of the train of thought, how things are changing with respect to climate specifically. Historically, the cost and opportunity of carbon has not been formally priced into asset valuations and asset decisions, and I think that is starting to change. Firms who can demonstrate meaningful progress towards meeting decarbonization targets are expecting a premium, whereas conversely, those who show lack of progress or lack of abatement are expecting a penalty with a range of premium or penalty depending very much on the sector. To what extent, and perhaps Neil, if I can come back to you for this one, is a company's carbon footprint specifically either an incentive or deterrent perhaps for investment?
The carbon emissions and footprint of a business is something that we look at now across the board with each of our acquisition opportunities. I wouldn't say it's necessarily that easy to get the data in all of the businesses. We're in the mid-market space. A lot of these businesses don't have a footprint, or if they do have a footprint, it might just be scope 1 and 2, but without any sort of thought around scope 3 emissions. A lot of things can be done from the outside in terms of looking at the operations of the business and the emission intensity, which you can do with your advisors without needing to get into too much interaction with the sellers or the company being sold. I think it is still quite difficult to have that as a front and center conversation with sellers. And, you know, wearing my ESG hat, you know, our investment team is obviously trying to use its time and let's say, ability to ask a certain number of questions to a limit. And so where we've really found there's value is working with advisors who can help us on the outside in to work that out. And then immediately after the acquisition, working with the management teams for them to start to adopt a decarbonization pathway. And I think that's we'll come on to talk a bit about it later on in the panel, but I think that's where the real difference can be made within the management teams really owning their own emissions profile and ultimately owning the decarbonization pathway, because there's a huge opportunity for private capital to contribute in this area, even if public policy is oscillating a little back and forth. And I think in that regard, companies who do this well will really be recognized, and we can see this with management teams that have adopted this, will really be recognized because their customers, their employees, their other stakeholders are really interested in reducing emissions.
Ashim, did you want to come in on that?
Yeah, I mean, we talked about me maybe giving some case study examples whenever I can, and so I think I probably have a good one here. So when we acquire businesses, sometimes they may come to us as, so we have a fertilizer business. Now that is even done well, quite a dirty business, you know, it's high emitting, but actually the opportunity there was about decarbonising it or around decarbonising it. And so what we've done with that company, they produce ammonia. I mean, I won't get into the chemistry and the physics today, but ammonia is typically created from natural gas and the byproduct is carbon emissions. There's another way of doing it. You buy an electrolyzer, and if you power it with clean power, then you can use water, and you get the H for the hydrogen part of it from the H2O. I'm getting too deeply into it. But you can make it in a clean way with clean products and equipment. So we've put in additional equity to buy some electrolyzers. We've done power procurement with utilities who can give us 100% clean power in Spain and in Sweden. So it's like wind and solar and hydroelectric. And then we have green hydrogen and then green ammonia at the end of that. Now, that is, you know, chemically the same product as normal ammonia, but in terms of its sales potential, it's treated as a different commodity. And so now we have offtake agreements with PepsiCo and Heineken, big companies who want to buy large volumes. And so you have a completely clean kind of value chain and a new source of revenue. And with that comes different valuation. And so we're talking about businesses like that with different sorts of funds who may have a different mandate and be able to, you know, look at different kinds of multiples because it will fit their impact credentials of their fund or such like.
Again, what a fascinating example. Adina, did you want to come in as well, either with examples or more generally on valuing carbon?
Yeah, I mean, it's definitely an increasing area of focus around energy efficiency, decarbonisation plans. We've been working with one of our healthcare companies at the moment on looking at decarbonisation for one of their sites, and you know, kind of identified some really good opportunities to actually get them to zero carbon at that site with a 3-year return on investment. And so I think there's some, you know, really great opportunities out there. We're also in the Sustainable Markets Initiative. So for those that don't know, this is an initiative that brings together CEOs and managing partners from different industries to talk about sustainability and the challenges that industries are facing. So in the private equity task force of the Sustainable Markets Initiative, we've been involved in a working group to look at valuing carbon in the private equity industry. and worked with BCG on developing a bit of best practice guidance around this to really act as inspiration for the industry. It's on the SMI website. Go and check it out if you haven't seen it. And on the back of that guidance, we've been looking at how should we be thinking about, pricing carbon at Permira, and so done some initial work around developing an internal carbon price and then starting to apply that to our existing portfolio and piloting it on a number of investments. So I think, some really interesting observations there, and will help us take this valuing carbon piece out of looking at energy-intensive operations to looking at, different types of businesses that in the past would have been seen as like lower impact around carbon. So it's early days, but I think a really exciting development for the industry to start thinking about pricing carbon in a different way.
Yeah, can I just add one more thing, is that I think we are at least also now factoring carbon and emissions as part of our portfolio construction. So as you're building out a fund with a number of different investments, if you have more emission intense assets at the beginning, then as you build out your portfolio, certainly that's something we're thinking about, is finding the opportunities that are lower intensity in order to diversify risk.
Fantastic. Then changing tack slightly and looking at the other side of the coin when it comes to climate, while much of the focus is undoubtedly on companies' carbon footprints and the credibility of their transition plans, do you already consider the physical risks associated with an investment? And by physical risk, I mean both acute physical risk like flood or wildfire, or those that are more chronic, like heat waves, drought, precipitation, stress. Do you already consider that, or is that the longer-term nature of some of these perils perhaps at odds with your investment horizon? Ashim, if I perhaps start with you.
Yeah, sure. I mean, I think forward-looking GPs are already getting well involved in this theme. So you named many of those categories of extreme weather event, which are exacerbated by global warming, and it's not a future risk. The data shows they are becoming more frequent, and when they occur, they're more severe than they were, and so that brings more flooding and more drought, more wildfires, heat waves, storms, and it doesn't just happen in faraway places anymore. It happens, where many of us live and work and hold our investments and raise our assets, and so it's a real risk now to production, but also it's a theme around which we can invest. And so at Triton this year and last year, I've been effectively mapping out against, you named them, kind of 5 categories of extreme weather event, 4 sectors we invest in. I won't go through them all, and then a matrix really. So, products and services which give solutions, which build resilience around some of those risks as they come through, and that's led us into real areas of sourcing. And so, when we think about the fact that there's more, one year there's droughts in Germany, and the next year there's floods, and that's affected our industry. So now, when those sorts of events happen once every 50 years, you just kind of get through them and maybe don't spend too much money. If your house flooded once every 50 years, you just mop up. But if it happened once every 5 years, it would go from being like OPEX to CAPEX. You'd build resilience against the next one. And so we want to be in front of that trend and owning the companies which can provide flood resilience technology, or in agriculture, greater irrigation technology. So it's a bit of a long answer.
Oh, but very good, and shows just how tangible some of these are already today. Neil or Adina, anything to add?
Yeah, I think it's now. Like, we're all sitting here talking about it. Our investment horizon is up to 12 years. That's 2035. We're going to be in the midst of all of this. So there's no doubt that it needs to be considered now, and it does need some specialist input, because some of the scenario analysis around what's going to happen in specific locations around physical climate changes is really, really bespoke. To give you an example, we were looking at a data center asset in a European geography. It was located close to a watercourse, which in somewhat distant past had flooded, but not while this data center had been there. And it was a single site. And in the end, the deal didn't go ahead for commercial reasons, but we were this element fed into it, which was, we were very concerned about what would happen from a stranded asset risk perspective. If you imagine you've got your IT equipment in a data center and it floods, no one's coming back again. So that really is like front and center of our minds now.
Then I'm conscious we've got quite a lot of questions coming through, which we haven't paid much attention to so far. So I will pick the one that's got the most thumbs up from the top of the screen, What's more important, excluding from the portfolio or investing in / helping to change businesses that have poor ESG credentials? Any volunteers, perhaps from the panelists? Adina?
I'm going to give a suitably vague answer that is, it depends. I mean, it really does depend on the investment. And so we really look at investments on a case-by-case basis. In some cases, you identify ESG issues, and we take the view that we can actually improve this business during the course of the investment, and that will be a key part of like the value creation plan. And when we get to exit, the business will be better positioned. In other cases, there's just risks that we can't get comfortable with, and we've walked away from deals in the same way that others have, where we just, kind of can't get comfortable with that risk going in, or wouldn't be able to sufficiently influence during the investment period to change that risk.
Yeah, I think it comes down to the management team's attitude and also whether the actual business model is capable of transitioning. We've excluded some opportunities where they just have too much exposure to fossil fuels. But on the other side, this is a place where private capital has a huge opportunity to invest in the transition. And, although sometimes difficult situations are ones that are time intensive and need the most work, but they're also the ones that can create the most value by bringing our capital to solve issues across the ESG sphere.
Then I'm conscious we've got about a minute or so left, and this question was actually very much related to the topic in which we would like to close this panel discussion with, which is risk mitigation versus value creation. A lot of times the narrative when it comes to ESG is very much focused on risk mitigation, risk avoidance, regulatory compliance, reporting, data, etc. And I think Pam Hendrickson earlier touched on value protection being in focus in challenging market environments. In what areas do you see, and perhaps in sort of 15, 20 seconds each, do you see the greatest potential to use ESG as a lever for value creation and growth? Adina, perhaps if we start from your end.
Yeah, it's a great question. On climate and energy, obviously you can really kind of link that to value, and it's easier to show, that connection. I think as well for, like, we invest a lot in consumer businesses or healthcare. I think having a kind of well-rounded strategy on ESG, covering the material areas, that also can really kind of, link to value. Obviously, it's harder to kind of calculate exactly what that value is, but we know that that is a really important part of the exit story.
I think aligning what you're doing to the SDGs, and I think one of the things that we've really been focused on in our investment strategies is the themes that are going to drive and what Europe requires for its future infrastructure needs. And when you start looking at that and deploying capital into those future needs, it is a very powerful story about how we can bring capital to pursue the opportunities that are out there to achieve society's ESG goals.
10 seconds. Increasingly, the reason I joined Triton 2 years ago was to more fully embed sustainability across the entire PE cycle. We find it's increasingly important to our investors, so to raising the money, then how we allocate that money, how we spend it, where we choose to invest the assets that we buy. Sustainability is a core lens to doing that. How we manage the assets over time, mitigating the risks of the companies, finding growth opportunities, and then the exit piece as well. Increasingly, whether it's a strategic buyer, another PE buyer, or an IPO route, sustainability credentials are key to understanding the risks associated with any valuation and the future potential of that investment.
Thank you very much, all. And I think our time is up for this panel, but thank you so much to our panelists for sharing your insights, your perspectives. Apologies to the audience that we haven't covered all of the questions that have come through, but do find us in the breakout sessions, and I'm sure we'll be happy to tackle those. And thanks for joining.